In this video, learn how to get started backtesting a trading strategy. Hi, I'm Mike Bellafiore, co-founder of SME Capital, and we're a proprietary trading firm located in Midtown Manhattan. And I'm also the author of the trading classic, One Good Trade, and the playbook. In this video, learn how to take a trading idea that you've developed and test whether it truly has an edge. Said another way, whether it really would make money trading it live. That is a super important trading lesson to learn so you can grow your trading account.
Hi, so my name's Yanni and I'm with my partner James, and this is an introduction to backtesting. So what is backtesting? Backtesting assesses the viability of a trading system by methodically using a historical data set to see how well a trading strategy works. The underlying theory is that a strategy that worked well in the past is likely to work well in the future. And since markets are always changing, it's important to always adapt the system and recognize bias. The ideal backtest chooses sample data from a relevant time period that reflects a variety of market conditions, and the strategy should be developed without relying on the data used in the backtest. We first build out our strategy, and then we use relevant data set to measure the success of that system. So it all starts with a question. So every backtest starts with a question, and how profitable, so for example, how profitable is a simple moving average crossover? What would a mean reversion strategy look like with Bollinger Bands on a high beta stock, right? And then we design and test that question. So the next step would be write out that code and test it out. And the accuracy of the model versus the real execution will likely vary in the test stage. And then after that, we analyze the backtest. We interpret the results of the test and iterate it. The results may be surprising and not what you expect, and you cannot disregard this. This is very important. So what's the difference between backtesting versus using an automated strategy? Traders can turn a trading strategy into precise entry and exit systems with rules and automation that allow computers to execute and monitor the trades. Automation can take some emotion out of trading since trades are automatically placed once a certain criteria is met, but discretionary trading, on the other hand, is adaptive to current markets, and by combining both automation and discretion, a trader can identify his edge and use his cognitive skills to make a good trading decision. And backtesting could be another variable behind one good trade. So what does that mean? Well, like we have multiple variables in our trading system, backtesting could give you more confidence in a certain strategy. So here are some backtesting tools that I like to use. Some free devices include manually backtesting with charts, Microsoft Excel or Google Sheets. TradingView has an excellent backtester if you know some coding, or the Thinkorswim on-demand feature is also very helpful. And some paid software with also historical data is CloudQuant, FinViz, CML Trade Machine, SpikeIt, Market Chameleon, and Options Slam are both really good options if you trade options. For this example, we're going to be using CloudQuant.
If you want to learn 3 more real-world setups that our traders use, including the simple setup that we teach all of our new traders, and the setup that turned one of our traders into a 7-figure big money earner, check out the free webinar that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open up the free registration page in a new window, so don't worry, you won't lose this video. You can also visit tradingworkshop.com to register for this free intensive workshop. You're going to learn more in a couple of hours from this trading workshop than from years of online education.
Okay, so as Yanni just explained, we are going to be using CloudQuant for this example. The purpose of this example is not to give you some spoon-fed strategy that's going to make you a millionaire. It's more to go through the process that we just described of ask the question, design a test, analyze the results, and iterate. So in this situation, we're proposing the question, what is the best way to approach a stock near its 52-week highs when it attempts to make a new high? So that means once it's already near its 52-week highs and it goes to make a new high, what is the best way to kind of approach a stock like this? So we can go through and kind of design some general parameters of what we're going to be looking for. And the first step to specifically with CloudQuant is called symbol qualification. So what that's going to do is take a large basket of all the stocks that CloudQuant offers backtesting with, and you have to filter it down to the ones that you want to run the individual scripts on. So this is your highest level filter to kind of get rid of everything that isn't generally what you want within the test. And in this case, what we're going to be getting is anything that is within 1 ATR of its 52-week highs. So that's going to make sure that it's near, that's how we describe near its 52-week highs. So what you'll notice there is that I'm taking a descriptor that humans can easily understand, right? Near 52-week highs. And now I'm quantifying it. I'm giving it a objective term, which is within 1 ATR. So that's a common theme that you're going to see over and over again when designing backtests or automated models, is taking things that humans can kind of abstract and understand and applying that in a more objective sense. So that's the first parameter. Then we're going to go in and we're going to find, once they have that, they also have to have at least 5 million average volume. Now, average volume is going to be a relative term based on the platform you use. In this case, I believe CloudQuant documentation will say it's a 14-day rolling average of that volume. And finally, the previous close was above $20, just to kind of eliminate a lot of the low floats, or just as more of a safety precaution. So those are the main filters. Now, once those are met and that criteria is met, you can then call the symbol qualified, and we'll move on to the next stage, which we're going to talk about in more detail on later slides. But essentially, the pseudocode for it, or the way we're going to logically think about it, is that once we kind of have this basket of stocks that meet our minimum highest time frame filter, then we're going to go and we're going to watch it. And if it puts in a new 52-week high, meaning it breaks that high that we were within 1 ATR of, now we have two different options, which is right here, right? The first option is we can buy it, and we're going to hope that it just continues to go higher. And in this case, we're going to define our risk as the previous day's low, risking $500, and close it out at the end of the day if it did not stop out. So this is going to tell us essentially that if we are at near a 52-week high, we break into a new 52-week high, and we just close it out at the end of the day, risking that previous day's low, what is the result of that going to be? Now, the second thing we're going to test is it's near that 1 ATR, and it breaks into a new 52-week high, risk 1 ATR at $500 and cover it at the end of the day. So the difference that's important to understand here is that we had to kind of make up a risk target for the sell side, because you're breaking into a new high. So if you break it into a new high, you can't risk the previous day's high because you're already above that. So we just say 1 ATR, risk it at $500, cover it at the end of the day. And this is going to allow us to take this question and analyze two different routes of approaching it to see where we might be able to dissolve some sort of expectancy out of it. So this is what we just talked about, qualification. I'm not going to beat a dead horse on here, but this is what the code would actually look like. It's just going to be coming in saying, we're going to get the last 252 days of daily bar data. This is going to be important whenever you're back testing. So what this is simply saying is that we just asked CloudQuant for 252 days of daily bar data. The next thing we have to do is actually check and see, did CloudQuant give us 252 days of data? Because if it did not, then we're not going to actually get an accurate result. It could be a stock that just IPO'd. It could be a whole plethora of issues, but this is what you'd call data validation, to make sure that what you asked for, you're actually getting. So once we make sure what we asked for, we actually received, now we can define that year's high, which is simply going to be the highest value of this array that it returns in the bars.high. So you're getting the maximum value of all the highs throughout those 252 days. And that's what we define as the yearly high. Finally, what we're going to do is what we just talked about. It needs to meet all of that criteria we just said. So this is how you take what we just wrote in the previous slide and move it into actual code. So the previous close had to be above this 1 year minus 1 ATR, which puts us, that's actually not needed, but this is because I used to have it at 2 ATR. But this is what's saying it needs to be near. So this is how we defined near, above $20, average volume 5 million. All right, so now we'll move on to that secondary part, which is the stalking part we described. So at this stage, what we're looking for is the previous day's low, and we need to get that so that if we do end up going long, because the code we're looking at, I should explain this, is for the long side. So we're looking at the code for option A, which is where we have the 52-week high, we breach it, we buy it as it breaches, and we look to close it out at the end of the day. So in this case, what we're going to need is that previous day's low, just so we know where we're going to risk off of. Something else important that you'll notice about this is that I'm going to be turning it into a float, which is just going to be converting the data types. So a lot of the times when you're backtesting, it's going to be a fight between you and the data that it's being returned as. So you have to pay close attention to what data type you're working with. Now we're also going to have to get the last 252 daily bars again in this section, which is the same thing we did on unqualified, but in this case, we're doing it on minute bar. So CloudQuant's an event-based backtesting system, and on minute bar is exactly what it would sound like. Every minute, it's going to trigger, it's going to trigger, it's going to trigger. So what we're going to be doing here is we have to redefine the year's high because we have to check if we're going to break it. So we need to get that year high value again, and we need to have this yesterday's load of risk off of. Once we have that, and we have the data validation, now we can move forward with checking to see if the stock is going to go and break that previous 52-week high. So again, the same kind of data validation we just did above, just checking, does it exist? Are we above yesterday's low? And did we actually get a yesterday's low value? So this is how I'm just saying, does yesterday's low exist? Because I set it to a default of 0. And if it's not 0, that means we got it. So it's a stock that's above $20. It's going to have a previous day low that's not 0. So that's what we're going to be kind of validating that with. RVol above 3. And this parameter here, self.step, is simply an internal tool that we're going to use throughout the process to track where we are in the script. So we started off the script with self.step being equal to 0. And that's something not shown in these slides, is this self.step section, which is in the onStart part of the script. So if you go to CloudQuant and you look at a example script, you'll see this in the onStart section. Now we go back and we redefine the year's high. We've already gone over what this is actually doing in the symbol qualified section. So we don't need to go over that again. Then it's very, very simple. If the current price, which is this MD market data dot L1 dot last. So if you go to CloudQuant documentation, you can find CloudQuant market data L1, and one of the options it has is last. So this is going to give you the last price that the market traded. And because it's in the on minute bar, it'll essentially be the close of that minute bar. So if the minute bar closes above, I called it year high, the 52-week high, now we want to buy the stock. So now we have everything we need to buy this stock. The next thing we're going to do is determine how much of it we want to buy. We just talked about how we're going to be risking the previous day's low, and we want to risk $500. So we're going to take $500 and we're going to take the current price minus the previous day's low. So that's the amount you're risking, is the current minus where you're going to stop out, and divide that by 500. This is important. So this is just going to turn it into an integer because we need to have whole numbers. You can't buy a fraction of a stock. Well, you can, but not in the way we're talking about it. So we need to have whole numbers so we know how much we're going to buy. So a lot of these little things will come to bite you when you're back testing. Then very simple, just order.send, buy the symbol, market order. This is going to be helpful for us in the debug section, where we're simply just going to see, okay, we bought this many shares of this symbol at this price. Now here's where we bring that step back in. Now we're at step 1. This way, the reason we do this is so that once we're at step 1, we don't run this code again, because the next minute that executes, it's going to say, are we at step 1? Yes, we are, which means this is now false. So we will no longer run this code. And that's why we issue this return command to return it back to the top so that we don't accidentally buy the stock twice. Now it's the closing scripts, right? We're still inside of on minute bar. The reason we're doing all of this in the on minute bar section is because this is a backtest. We're not trying to make an automated model. So we want the backtest to be quick, because what you'll notice is that I did an entire year. All of 2020 is what I ran this backtest on for A and B. And if you did it in the on trade section, which is another part of the event-based CloudQuant options, it's going to execute that code on every trade that goes through the market. So it'll take magnitudes longer to actually run the backtest. So doing an on minute bar is going to give you a less precise backtest, but it's going to actually be able to do it in a much more efficient manner. So now we have this first command here, which is, are we at step 1? The reason we have this here is so that we know we're in a position before we try and get out of a position, because we don't want to get out of a position before we're in one. Simple enough. And if the last price is below the place we're risking yesterday's low. So this means if we're in a position and we're below the place we want to risk, then stop out. So tell yourself you got stopped out, take the amount of shares you currently have in your account, and you define that as shares, which goes right there, and you just mark it out. Now you set your step to sell to 3, just so that this doesn't execute again. Terminate the script, return. That way you close out the script, it's done for the day. The other way we exit, again, step 2. So the reason I have this here is that you want to have it exit at the end of the day if it does not stop out. So now we have it set to 1550, right? So 1550 is when it's going to close out at the end of the day. It's going to say exit at the end of the day. Same thing, we get the shares, we stop out, or we close out at the end of the day. So here is the analysis for option A. As you can see, kind of interesting, right? So it kind of made a little bit of money, was just kind of holding out there. COVID crash last year happened. It didn't do much because there weren't many 52 highs being made during this period. And then all of a sudden it just started to get wrecked and wrecked and wrecked. Over here, we can see kind of the stats. Something I found interesting is it hits just around that 50.75% win rate. Average trade duration was about 6 hours. So from my perspective, when I was first writing this, I thought this was actually going to be somewhat okay. I didn't think it was going to absolutely get destroyed in the way that it did. So I found this quite interesting, which is what brought me on to then approaching option B. So if we look at option B, first we're going to look at the best. So this can be helpful whenever you're analyzing backtest results, is to look at the best and the worst days of the backtest and see what it did. So CloudQuant will show you this heat map of all the trades it took. So what we can notice here is, I believe this is Morgan Stanley. So this is a 52-week high, right? It broke the 52-week high, got long, and closed out strong at the end of the day. So that's why it was such a good day there. And that's the kind of trade that we thought it would make. And then we look at the worst day, and here's NVIDIA, right? So NVIDIA, you can see it just made that 52-week high, because the 52-week high was around here, and then just absolutely dumped. So you basically bought the highs a day. So those are the two kind of best and worst days of that script. And that led us to the other side, which is part B. And part B is it makes a new 52-week high, we sell it, and we risk 1 ATR looking to close out at the end of the day. So this did kind of an opposite of what the other one did, right? It lost a little bit of money, didn't do much during COVID, and then was able to make some money. And obviously there were certain days here where it was able to perform very, very well. Now, like I said, this is not by any means something you want to plug and chug and just start trying to take trades on. It's still extremely capital inefficient. It's got a lot of problems with it, but it does give you somewhat of an inclination. So now we do the same thing. What is the best day? What is the worst day? So the short side's best day is a day like this, where it's just probing that 52-week high. So I know that's kind of, I ran out of space here, but 52-week highs around here, right? So you're just peeking into a new 52-week high, and then it's failing lower. And that's a lot of the times where you're getting the best side of this type of trade. And the worst day is going to be where you break the 52-week high and then you just keep pushing higher. So that kind of makes sense, right? And then you hit 1 ATR and you stop out. Now, something you'll notice is that these stop outs are over $500. And you might ask, why is it over $500? Well, that goes into what we were talking about with the accuracy. So because we're running everything in the on minute bar, you're going to have more slippage and you're going to have less accurate exits, because the stock might be moving a bunch, but you're only asking, what's the last price? Should we stop out? You're only doing that every minute. So you're going to have fluctuations because of that. So we're going to switch over to Yanni to go through these slides. The one last thing I wanted to kind of hit home with this is that this is now giving you two different stories, right? Option A, option B. And from there, your job from this point now is to take what is a very small amount of code. I mean, we just ran through all the core components of the code. It was not a lot as far as a script goes. Now you have the opportunity to kind of take that and what we said was test, analyze, and iterate on it. So now you build on top of it. You might ask the question, hey, if this is making more money when it fails, then maybe I want to add onto the script something where we wait to see a new 52-week high breached and then fail. And so that might be what you look for, is it look for it to go up and then come right back down. And now you want to get in, and now you want to short it. And so there's ways to kind of iterate on top of that, and paying attention to SPY conditions as well, overall market conditions for your best and your worst days is very helpful.
Here are the biggest takeaways from this backtest. This itself is a poor trading strategy with poor Sharpe ratios. And it's about a 50-50 shot if a stock near 52-week highs that puts in a new high will either continue or break down. If it fails down, the risk reward is better if it just grinds higher. But fading fresh 52-week highs that fails is best when, one, if the market is also failing off its 52-week highs. And this begs the question, what if we wait for it to go back below its all-time high, then short, risking high of the day? This is where further iteration of the backtest can take place. So here are some helpful tips for backtesting. Write out pseudocode prior to starting. So what that means is just writing down not actual code, but specific variables for that script. That way it's easier to design and think about linearly what you want the backtest to do. So you don't want to make any assumptions. The computer sure won't. So that brings us back to thinking linearly. A computer could only think like that. So make sure that you take the necessary precautions when you do that. You want to implement small steps and backtest them along the way to make sure that the script is behaving the way that you expect it to. Don't limit yourself. You could also use fundamental data, ML data, custom indicators, get creative with it. It's not just the data that we used in this script. So start simple and build on complexities, and understand the design considerations behind a backtest or automated model. Cloud Quant does require you to know a little bit Python and have some coding experience, but they do have education and training exercises that you could do to learn Cloud Quant. There's also some paid softwares, like we mentioned, that you're able to not know how to code and backtest, but again, that's paid. So say if you want to do something for free, it does require you some coding experience.
Yeah, Cloud Quant has a bunch of YouTube videos, and their documentation is great. So you can start out for free with Cloud Quant Lite, and then based on the features you want to use, it might be advantageous of you to upgrade to the paid version. But there is a free version and pretty good documentation for the Cloud Quant Lite scripts, as well as a ton of examples.
Hey, go ahead and click our subscribe button so you don't miss any of the videos that we're producing for you in the trading community. And please take the time to add your feedback in the comments section for what videos you'd like for us to produce next, and what you found helpful from this video. From all of us at S&B, train and trade well.